My dad watched his life's work literally walk out the door. These were my dinner table conversations as a child. Thefts, employees pulling knives when the payroll was a day late, corrupt optical unions, distribution challenges, bankruptcy risk, not the stuff your typical elementary school kid hears.
Hey, listeners, welcome back to the Valley Beach podcast. And today I'm really excited to be here with Jason Hirschman. I hope I pronounced that correctly. If not,
Hirschman,
I'm
but
really
it's
sorry.
close. It's close. No worries.
Yeah, but Jason is one of my favorite investors out there. I've learned a lot from studying him and also just talking to him. I guess we spoke once before.
Mhm.
So, yeah, I think this will be a great conversation. And Jason will bring today two case studies from his past investments. So, I guess this will be a more dynamic way to learn about an investor's journey and practical too. Then we'll have obviously some questions on his investing philosophy and personal questions as well. So yeah, Jason, why don't you say a couple of words before we dive into it?
Sure. I'm a full-time investor running a family office, Hudson 215 Capital out of Las Vegas, Nevada. In 2022, I disposed of the family business and devoted all of my professional energies to investing, having guided a portfolio from 5 figures to 6 figures, then seven, then eight, and finally nine. But David, there are two other dates that reveal a lot about my investing journey. In 1980, my dad came back from South Korea, where he was establishing a small factory in a free trade zone in Masan. It was so expensive to manufacture low-value optical goods in the United States that our family business was going under. Bad jet lag, so he drove at the crack of dawn into Greenwich Village, New York City, where our optical factory was located. Lo and behold, he goes up the elevator and sees a crew of guys stealing stuff from the place. At least one of them is carrying a gun. Goes back down, calls the cops from the payphone on the ground floor, sits there in the lobby and waits for the police. Watches these crooks carry stuff out the door, trip after trip. Finally, two cops come while the crew is upstairs. Dad runs outside to explain the situation. The cops insist that they can't double park their police car and have to look for parking. Of course, they purposely take a long time to find a parking space and come back after the criminals left. My dad watched his life's work literally walk out the door. These were my dinner table conversations as a child. Thefts, employees pulling knives when the payroll was a day late, corrupt optical unions, distribution challenges, bankruptcy risk, not the stuff your typical elementary school kid hears. The other date, the other date that's important to me is like 1996. This is when I rejoined my family business after a short stint in consulting. Very quickly, I determined that our family business was in an industry in long-term secular decline, and we had to invest every dollar possible into things that offered better long-term returns. As a side note, if I asked your listeners what event occurred on the 11th of a month in 2001 that most affected the economic and military security of America, 100 out of 100 people would rightly point to 9/11. But a close second in my book, arguably number one actually, occurred on December 11th, 2001, the day China became a member of the World Trade Organization, the WTO. Among other effects, this changed businesses tied to USA manufacturing, like my family's, in profound and difficult ways. Because of these experiences, David, words like volatility or risk or concentration may have a different definition to you and your audience than to me. The rough contours of my investing approach were shaped quite early, though refining them took many adult years, of course. Now, I do understand we are going to do something different with the podcast, talk about specific stocks first. But if I may say, the two stocks we're going to talk about today are Nordrest and Theon. Even if you never heard of those two specific stocks, Nordrest trades in Sweden and Theon trades on the Euronext Amsterdam. I hope the discussion offers lessons widely applicable to many microcap and small cap investors. But David, if you don't mind, before I speak about Theon and Nordrest, can I take another minute or two just to describe like Hudson 215 Capital's like investment approach? Good. Thank you. I think you can't go wrong asking yourself the first few questions about a prospective investment that let's say Warren Buffett and Charlie Munger asked themselves. At the Berkshire Hathaway annual meeting in 1995, Buffett and Munger discussed like these initial questions. Buffett's first question: can I understand it? Right? For Theon, the answer is yes. We can do the research, and that includes numerous calls with management, expert calls, speaking with other Theon investors, and a site visit to their factory in Greece in November 2024. Likewise with Nordrest. Buffett's second question is, does it look like it has good economics? Has it earned high returns on capital? Does it strike me as something that's likely to do that? And I think Charlie Munger added, like we tend to judge by the past record. If the thing has a lousy past record and bright future, we're going to miss that opportunity. And I think that's a key difference between the Buffett Munger approach and the approach we take at Hudson 215 Capital. We like best the microcaps and small caps, where the earnings and free cash flow track record is short and spotty, the present is muddled, but the future is potentially bright. Of course, there are a lot of investors who like turnarounds. The problem is often they don't actually turn around. The fundamental business just continues to deteriorate. The stock is a melting ice cube, or one of those close but no cigar business models. Our approach is to favor companies that favor companies where the turnaround challenge is non-operational. We want management to keep doing what they're doing on the core business, and for the change to occur like outside operations. Now, what do I mean by that? For our big winner, Expel, the challenge was a patent lawsuit with 3M. There was a lot of pathways to victory or settlement that did not dramatically affect the core business operations. FYI, Expel makes paint protection film and automotive window tint. We were quite confident in Expel's management and believed continued growth would lead to operating margin improvement. The fundamentals were rock solid. Non-operational issues had to be addressed, like the lawsuit had to end with a reasonable settlement. Expel had to uplist from the junior exchange in Canada to the NASDAQ. For Hype, an online nicotine pouch retailer we own, what was required was a shift in investor perception about nicotine pouches. Again, it's another non-operational challenge. The core business just needed to keep on chugging along. Growth creating operating leverage, and margin improvement. For our alternative asset managers like Apollo, Ares, and Blackstone, we primarily invested from 2013 to 2015. Again, the businesses were doing great. They just need to convert from K1 partnerships to C corporations so that more investors could buy shares, and to focus investor attention on the steady fee-related income rather than the cyclical carry income. I think investing in problem children with non-operational challenges, we think that offers like superior risk reward. So, any questions, or should we move on to discussing Theon?
No, sounds like you were very, very comprehensive, and so I think I don't have any questions for now.
Okay.
I'll save them for later. Yeah.
Okay, sounds great. Sounds great. So, Theon, just to give a little bit of background, Theon was listed on the Euronext Amsterdam in February 2024 at 10 euros a share. Theon is a leading manufacturer of night vision goggles and thermal imaging. So, think like clip-on sights for military purposes, with approximately 50% market share in Europe and approximately 20% market share worldwide. It was founded by Christian Hadjiminas, and pardon my pronunciation, in 1997. It is located near Athens, Greece. Last year, Theon printed 350 million euros in revenue, up 60% from 2023, and is on track for 20% top line growth in 2025. We discovered the company in April 2024 while looking through a list of recent IPOs in various stock exchanges. Did the same thing with Hype Group, actually, in 2022. Now, Peter Lynch, the famous Peter Lynch, joked that IPO stands for it's probably overpriced, but we think there are exceptions to the general rule. For many reasons, including the fact that the Euronext Amsterdam only listed 3 new IPOs in 2023, Theon just didn't get a lot of attention soon after it went public. Hype didn't get a lot of attention too, in part, but that was because Nordic fund managers at the time were infatuated with ESG, feel good, sustainability, happy talk, yada, 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 like stuff. After the IPO, Theon had 70 million shares outstanding. So, 10 million, I'm sorry, 10 euros a pop, 700 million market cap, free float of about 20% of shares, 94 million euros raised, enterprise value of roughly 650 million euros. David, you interviewed Maj Sweden, who's a great guy. I made a pitch on Theon last January on one of his podcasts. I think Theon was about 1366 at that time. At Euro 2950-ish or so currently, that's a pretty strong return in a short period of time, which suggests to me a combination of skill, but also lucky timing. Now, here was a company in the second and third quarter of 2024, when we did our buying, that was performing well. What was evident back then? Growing book to business, 50% estimated top line growth for 2024, and the prospect of 15% growth annually. It was tracking, let's say, a 20% unlevered ROE, mid-20s EBIT margin, trading at, let me think, about 10 times or less current year EBITDA. So what had to change for the stock price to rise? Again, non-operational issues, mostly perception and familiarity. In mid to late 2024, when I was speaking with fellow American investors, there was great skepticism that Europe would rearm. When I spoke to European investors, there was great skepticism that Europe would continue to rearm because there was a general understanding that Europe was already taking modest steps to increase defense spending. Certainly there's a European Parliament trying to centralize power with a heavy hand regarding regulation. Well, post-Ukraine, our theory was that betting on centralization was consistent with betting on defense spending growth, not against. The idea of European pan defense. I'm willing to bet on centralization in Europe, but not on decentralization and deregulation. What I want to underscore is that we did not underwrite Theon dependent on a major NATO spending boost. All we needed was Theon to grow moderately, and for certain post-Ukraine invasion military spending trends to continue, not necessarily intensify. The Trump NATO defense agreement, which is going to boost defense spending, is icing on the cake that has turned an investment set up for a strong return into potentially an outstanding return, but it wasn't something we were baking into the cake. Intelligent investing to me is asking and answering the same kind of questions like a kindergartner asks his parents, why is the sky blue? Right? In 2016, why does Expel grow so quickly with no marketing spend? Why does Hype have 80% online sales share in Sweden? Why does Theon have 50% military night vision goggle share in Europe? I love seeing microcaps and small caps, which enjoy high market share in a moderately sized but growing niche. This is the opposite of many microcap investor decks, which illustrate a tiny share in a theoretically huge market. So let's address some of these questions, some of these why questions with Theon, right? The USA prohibits the latest night vision goggles from being exported because of ITAR, which is stands for International Traffic in Arms Regulation. It's basically a set of laws to restrict certain American military products from being exported. Theon also doesn't compete with Chinese products because Western and Western-aligned militaries aren't going to use Chinese military equipment like goggles. So your toughest possible competitors are already hamstrung. There's a secular trend that was already taking place, shifting night vision goggles from special forces to widespread use, a trend that was accelerated because of the Ukraine war. And finally, within the West, Theon combined high-quality, low-cost manufacturing and engineering talent in Greece. And one more thing I would got to add, of course, which is always important, just entrepreneurial founder talent. I think it's important to find out if a company has done any kind of real-world innovations, little nitty-gritty. So I have a couple examples for you. Believe it or not, in the past, military night vision goggles had batteries that were difficult to replace in the dark. It sounds stupid. If a soldier forgot to replace his batteries before the mission, he might have to turn on a flashlight to replace his night vision goggles in the field of action. So I wouldn't want to be standing or sitting next to that guy while he does it, for sure. So it's totally ridiculous. Theon came up with a design so that the batteries could only be inserted one way, so you could do it in the dark. Small innovations like that, right? Or coming up with a electromagnet mount instead of a mechanical gravity mount, which will turn off if you tilt your head. These kinds of differences, these things make like a big difference to the soldier in the field, and by extension to the prospect for winning tenders. Our job as investors is to discover the little things that add up to big advantage. I have never and will never ask a question like, "Tell me about your capital allocation approach," or the classic useless question to me, "What makes you stay up at night?" Because you're just going to get a programmed response. Instead, I just want to go down rabbit holes. Like if a company has multiple websites like Hype and updates them, then I want to know, like, okay, um, why did you choose to update Germany first? And then use some of that part of the response to ask another detailed question, like, why does adding a fifth sorting option on the website front end affect SEO ranking? Why do you use Shopify for one of your smaller sites? Do you think the trend towards nicotine pouch delivery to lockers in the UK will continue? Right. The more detailed you get, the better you are to judge microcap management and their ability in the future to take advantage of like presently unknown opportunities or avoid unknown problems. Right? The command of the nitty gritty is how like I determine whether the team has what it takes to achieve like microcap or small cap, like escape velocity. And think of a rocket, like escape velocity. So David, I'm going to stop there. Any questions, or should we
Yeah.
move on to Nordrest?
Actually, I have one question because
Sure.
I'm guilty of asking CEOs, "What's your capital allocation strategy?" And so I'm really interested in understanding how do you design the questions, because I feel like you one of your strengths is talking with management and really understanding the details. And so let's say I want to learn about capital allocation. What's a good way or more specific way to learn? Obviously it depends on each business, right? But for example, Theon or Hype, you talked about the websites and so on. What hints does that give you about capital allocation?
I mean, I'm not sure there's a specific hint about capital allocation, because I think if you ask a management team, about capital allocation, I don't think there. I mean, yes, you may get an answer that's like, like that shows they have like poor capital allocation skills, but you probably could have figured that they're a poor management team even without asking that question. Um, so I always just like to go, like I said, go down a certain rabbit hole just to find out, how they're thinking about various options. And sometimes you won't even get an answer that relates to capital allocation, but it's just a question of like how they are they nitty gritty decision makers. I've never met a microcap management team where if the CEO wasn't really on top of details, whether it really worked out. Um, it's just too small of a company, too small of a microcaps. It's just like these are small businesses, and if you don't have somebody who just like watches every little detail, I've never made like big money on that. So I just got to figure out like, are they detail oriented people? Um, and and uh, um, and um, for example, like this is how like I'll mention it a little bit later on too, perhaps when we talk about Nordrest. But like Nordrest, their CEO, I asked him a question. So like you have like a lot of 3-star returns. Like why or 3.5 star? Why don't you go in for 4-star or 5-star? And his basic answer was, look, it costs a lot of money to get that 4.5-star, that 5-star like review on average, right? It's the marginal returns aren't worth the marginal cost. To me, that just shows a mentality about how someone's thinking about profitability. Right? Because it's easy to say, we want to get 4 stars, we want to get 5 stars, we want to be the best restaurant possible. Uh, it's a little surprising to say, no, we don't want to be the best restaurant possible because we want to actually be profitable or highly profitable, right? So, especially when you get an answer that is sort of contrarian to what you expect. Like when we asked Hype one time a question, like early on, it's like, well, why don't you have more like subscription options? And the CEO was like, we don't want subscription options. We don't want people to subscribe because then they just subscribe to the same thing. Our websites are all about choice and selection, and we want people. We want the kind of customers at this point in time that are going to really take advantage of that. So I thought that was kind of interesting because that was not the answer I was expecting. And quite honestly, David, when it comes to capital allocation, a lot of microcaps, a lot of nanocaps, what are we talking about in terms of money anyway? We're talking about
Yeah.
like very small sums, right?
True. True.
So if you're asking somebody how are you going to invest 700,000 or 3 million or 4 million, $2 million, that's one thing. But if you think about in order for a company really to grow, they got to be able to invest 12 million, 15 million, $20 million, like 7 years from now at an effective rate. And I think that's, and I don't know whether you get those answers by asking, so, how do you think about capital allocation?
True. Yeah. Yeah. Makes sense. So I guess I'll try to design more
No,
specific
I mean,
questions next time.
it's just, I think also that it's in some ways, a lot of investors, probably because it's a lot of work to ask a lot of bespoke questions, a lot of like
Mm.
unique questions. But I think that's the way you actually get better answers.
Yeah.
When I went down to meet, I think Ryan Pape for the first time at headquarters, along with another investor, and we were just having a conversation about okay, where in the world are you seeing like the most usage of film, right? In a given area, where's like your per capita usage the best? And he pointed to a border city, Laredo, Texas, which is a fairly working class. It's not a very rich area. Which I was like, okay, but that's interesting. Okay, why is Laredo, Texas such a good market? Well, because they have some truck dealers down there that put some film on every single pickup truck. And it's mostly sold to like working class and middle class people. Well, that to me signals, well, this could be a much larger product, this paint protection
True.
film, than what people generally thought at the time, right? Which is just like a rich kid's toy, right? Just to protect Ferraris or like Lamborghinis and things like that. So, in some ways, you sort of wonder some of these answers, like, why aren't you telling the world about these things, right? But they don't necessarily, they're thinking as an operator, we're thinking as an investor. So our job is to like pull out little pieces of information that are they're not like violating any law or anything like that or any SEC rule, but they really sort of give a lot more depth, to like what the business could become.
Correct. Yeah, and actually one of the things, because of this project Value Bridge that I'm working on, is that CEOs like answer numerous times the same questions over and over again, and they already have kind of the answer in the back of their mind, and they already know what to say, and it's always the same questions. And one of the examples I give them just to make sure they know I understand them is that how many times an investor asks you about capital allocation. And so yeah, I think that's really powerful, like really doing the work. And again, like also for the CEO, if we put ourselves in the shoes of a CEO, like if you're talking with an investor that you can tell that did the work and actually is not wasting your time, you're much more likely to be responsive, right? And it's more win-win because you can gain from that interaction. So yeah, that's very interesting.
Yeah, and I think just this the question. I mean, questions that the a lot of investors like to go. They have like a set number of like eight or 10 topics they want to have in half an hour. So they go very wide, but not that very deep. I'd rather, and I don't even know. I will ask a number of questions, and then I don't know which area the CEO or CFO wants to go deep in. But whatever area there is, I want to go as deep as possible because I'm just trying to, you know, the value of the company or the management team is not going to be for the problems that I know about. It's going to be how he handles the problems that he doesn't even know about, that doesn't even exist today. So I'm really trying to judge that person's ability to just logically attack problems, right? And the deeper I get on a particular area, the more confidence I can hopefully get about their skills.
Hmm. Yeah, yeah, that's for sure.
So we go on to
So
Nordrest, or we have
yeah,
another question?
so, sounds like a plan. Yeah.
Okay. Okay. Well, Nordrest is also fairly new to the public markets. It went public, let's see, in May 2024 on Sweden's Nasdaq First North Growth Market. That's a mouthful. At 108 SEK per share. That's Swedish krona. I think for American listeners who are asking themselves, they're about 10 krona to a US dollar. Makes it easy. Nordrest is in the very unsexy industry of meal services for public and private enterprises, primarily in Sweden. Think of Sodexo or Compass Group or ARA Mark in the United States. Now, for example, Nordrest runs the restaurants at Volvo car factories or at Swedish museums or hospitals and elementary schools. It runs cafes and restaurants at colleges, at Stockholm's Arlanda Airport, at Swedish defense locations, and more. So in 2023, Nordrest reported 1.77 billion SEK in revenue. In 2024, revenue, I think, rose to 1.9 billion SEK, so roughly 190 million USD equivalent in sales. It was founded by Thomas Dalsalt, which again, apologies for the pronunciation, in 2014, who has a long history of involvement in the food service industry. Currently, he owns, I think, a bit less than half the company. The IPO offering consisted of 2.7 million shares, of which 926,000 were newly issued shares. The rest were sold by insiders and shareholders. So at 108 SEK per share after the IPO, its market value was about 1.3 billion SEK, with about 100 million SEK cash net of debt. So the EV was around 1.2 billion SEK. I actually also did a very short pitch of Nordrest on one of EVFC, FCF's Addicts, or basically Andy's podcast last September. Nordrest I think it was about 129 SEK at the time. So now it's closer to 185 SEK, and it's also paid a 5 SEK dividend. Again, pretty nice return. I suppose there are a few listeners so captivated by my voice they haven't looked up the company yet on their phone or on their computer. If you have, you may have noticed a 10.4% or so EBITDA margin. When I pitched it last September, Nordrest was trading a little less than 8 times EBITDA. Nordrest also has a large MRE, meals ready to eat segment with the NATO contract. This segment was responsible at the time of the IPO for about 25% of sales. What catches one's attention is about their MRE division is that sales went from about 49.5 million SEK in 2021 to 420 million SEK in 2023. Now, according to the prospectus, the operating profit for the MRE division was 120 million SEK. Nordrest's operating profit for the entire business was 156 million SEK. So there's that. Now, like many a Swedish company, it offers a medium-term financial goal, which is about plus 10% organic growth, and EBITDA, EBITDA, not EBITDA, about 8 to 10% goal, and a dividend about greater than 50% of net income, depending on acquisitions or investment needs. So what do we have, right? We have a 10% organic grower plus. We got meal services. We got MREs. Now, is this the kind of business, kind of company that you would investigate further, David? Just yes or no? I'm just curious.
Probably yes. Looks very interesting, and I also love how the Swedish companies actually approach IR because they are very clear and direct. So yeah,
Yes.
probably I'll look further.
Okay. Well, good. I'm going to give you and your listeners one additional piece of information. In its first public earnings report after the IPO, the first half 2024 report, Nordrest reported a 12-month trailing ROE of 139% and a return on capital employed of 89%. In 2023, before an IPO, they reported a ROE of, I think, about 118% and a ROCE of nearly 75%. So this is not the company, and this is not a company with any debt, right? These are basically unlevered ROEs. So again, some in your inner kindergartner, right? What are we supposed to ask, right? These are great figures. We have to ask the why questions, right? Why does Nordrest earn such great ROEs, right? Or why is there such a high percentage of its earnings tied to the MRE segment, right? Or are Nordrest financial results largely tied to the continuation of the Ukraine war? Or why does Nordrest earn great returns if it's competing with huge companies like Sodexo and Compass, right? We get back to the kindergarten questions. To be fair, one reason Nordrest reports such an extraordinary return on capital, ROCE, is that it utilizes K3 accounting instead of IFRS accounting. Now, I'm going to get a little technical here, but K3 accounting keeps operating leases off the books, which certainly shrinks assets and liabilities for like a restaurant kind of business for like Nordrest. Plus, K3 allows excess value over acquired equity in subsidiaries to be written off entirely at the time of acquisition against group equity. That's the big mouthful, rather than reported as goodwill. So the acquisition of like minority interests for its MRE business didn't show up as goodwill on the balance sheet. So again, the assets and liabilities need to be a little smaller. But fundamentally, this is not a business that requires a lot of capital. Often its kitchen facilities are owned by its corporate or hospital or defense clients and are already most kitted out. Nordrest relies on what it calls natural customer flow, like hospital patients and nurses, defense staff, factory workers who receive the food as part of a contract or are high probability paid customers because the restaurant is like right there. Even at Arlanda Airport, outside of Stockholm. Yes, there's some competition from other airport restaurants, cafes, but you're not leaving the airport before a flight and heading back to downtown Stockholm to get a different price, to get a different muffin or buffet option, right? That's not the way it works. So, Nordrest restaurants, they're all about efficiency, right? It's easier to plan out a daily usage given its natural customer flow than manage costs and manage costs to like the stable revenue. One remark from the Thomas, which I mentioned earlier, right? Like he doesn't want his restaurants to get like 5 out of 5 stars. He wants that 3.5 stars, right? So the marginal costs to achieve that 4.5 average review or the 5th star are negatively correlated with marginal profits. So given all these advantages, why was the MRE operating income such a high percentage of company operating profits? First, the MRE figures reported in the prospectus, they were misleading. Right? Central operating costs were not applied to the MRE division. But more importantly, even in 2023, Nordrest was suffering from like post-COVID effects. Certain corporate contracts signed pre-COVID weighed down the results. They were just money losers because they just keeping employees, a number of employees just didn't come back. In 24 and in early 25, even if the MRE sales were slightly down, operating profits held up because many of these money-losing contracts like rolled off. So, so much for the supposition that the non-MRE business is unattractive. Now, figuring out the Ukrainian puzzle was harder, and it still is an educated guess. Like Nordrest's MRE sales look tightly linked to the Ukraine war, right? MRE sales skyrocketed in 2022. Certainly, there's the Ukraine effect, but underneath that MRE growth is also like a tremendous market share shift towards Nordrest's Outmeal subsidiary within the NATO NSBA market. They just gained a tremendous market share. So I believe actually the market share shift effect is actually much greater than the MRE sales boost from the Ukraine war, even though it does not look so. Now, with the rise of AI, good old-fashioned gumshoe detective work and like exclusive conversations are to me like more crucial for alpha generation than ever. Right? AI may be great for stitching together public information, but it cannot replace conversations with like Nordrest restaurant managers or MRE specialists and NATO contract information that even AI systems can't pull off the internet, at this moment. In fact, even AI cannot tell you that the income balance sheet data for like Nordrest's most recent MRE acquisition or refo is actually available from certain Danish websites. It can't pull it. Now, what about competing with like Sodexo or Compass? The best situation is when a microcap doesn't have much competition from large and well-funded competitors. We all love that. The second best situation is when an industry, the second best situation in industry is where like size advantage can be effectively countered with the speed and flexibility like only a small company can maximize, right? And I'll give you an example. Nordrest does a good job balancing restaurant level manager flexibilities with corporate oversight. If chicken breasts or broccoli are expensive one week, Sodexo can't adapt quickly. Too much centralization. Nordrest is willing to take advantage of good deals, substitute thighs for breast, tail for broccoli, and knows its local restaurant managers expect these kinds of substitutions. Now, I suspect that some of your listeners may be thinking, like, why? I don't have time or the resources to do this kind of work on a Nordrest or Theon. I can't travel to Sweden and walk through a restaurant kitchen with the CFO or get a tour of a night vision goggle factory or have dinner with the Theon CFO at a fancy Michelin star restaurant in Athens. I'm at a big disadvantage. Well, in a sense you are, in another sense you're not, right? Like we own 200,000 shares of Nordrest, but we're not a top 10 shareholder. Most, but not all, the top 10 shareholders are long-term owners, right? There are barely 1 million shares outside the top 10 shareholders. So we own 20% of the shares held outside the top 10. We have to do the work because we're staying at the microcap version of like Hotel California. Like you can check out anytime you like, but you can slowly leave. That's like our life. So overall, like many advantages accrue to intelligent, hungry, smaller investors. Still, I'm not going to sit here, David, and tell you that it's like, quote, it's like, I'm not going to tell you it's not the size of your portfolio, it's what you do with it. I did small is nice, small is fun, but big is better. So, any questions about Nordrest, or should we move on to some other topics?
I was about to ask you,
Mhm.
if you had to say start from scratch, uh, how would you go about meeting with these people? Because I feel like partly the reason why you are able to talk with a restaurant manager or the CFO or whatever is because first you're nice to speak with and you do the work and so on, but also obviously the capital base you work with is like meaningful for them, so it would be unreasonable not to do it. So my question is like, how do I, David, with the I don't know how many figures portfolio, but small, not many zeros.
A smaller portfolio,
Yeah, yeah. Um, get to talk with, say, a restaurant manager or an expert.
It's look, and this is one of the disadvantages because I think it just takes more. You're just going to have to call them and hope that one of them is willing to speak with you, right? I think that's when it comes down to. It's if you can't get the CEO or CFO to sort of introduce you, I think that's what it comes down to. I think the small investor in essence has to put more time into a game and expect a lower hit ratio of their reaching out, and that's just the facts, right? And that's one of the joys of being a sort of a larger investor, right? You can have some expectation of maybe of getting a conversation with a CEO or CFO, but it always doesn't work true. I mean, we reached out to I think there's a Swedish compounder, favorite or maybe ex-favorite, Technion. We reached out months ago, and they wouldn't talk to us. And we fact said we're actually going to be there. We want to show up. Well, it's like no. Now I think actually they talked to some other investors, but for whatever reason at that point in time they weren't willing to talk with us, and that's okay. I mean, not everybody. You're not always going to get a conversation. But a number of these companies do have like IR guys, and sometimes you got to speak to the IR guy first. Hopefully, ask him some questions that he can answer, and then you'll get, introduced to to the CEO or CFO. But it's tough, right? I mean, these CEOs and CFOs are busy, so they have to allocate their time efficiently.
Yeah, yeah. I think we in the case of Technion, I used to be a shareholder, and I think they actually made like a policy where they wouldn't talk with investors for some reason. So yeah, don't feel bad
No, no, no. I don't
for
feel
that.
bad, and it's not a and this is one of the downsides. Like if you do really like talking to CEOs or CFOs, like are you ignoring companies which are like obvious where the odds are stacked in your favor just because you
Mm.
can't talk to a CEO or CFO?
Right.
Um, right? If that's part of your process and you want to check off that box and you insist that that's a box that must be checked off,
Hmm.
well, then you're really limiting yourself also. So I
Right.
mean, we like that. We prefer it, but we understand that you can't always get that. And by the way, I mean, uh, I mentioned Apollo, I mentioned Ares, I mentioned Blackstone. Uh, Steve Schwartzman at Blackstone, billionaire that he is, I've never tried to make a call to him, and I would never expect for him to call me back. Right? He doesn't. We're never going to sit down unless we happen to bump each other at the airport. And I don't think he flies public. I bet he flies private. So.
Yeah.
It's you're always going to be at some portfolio level, unless you work for like Fidelity, where you're not going to be able to talk to a management team that you want to.
Yeah, yeah, yeah. That's for sure. Sometimes we also just like put up barriers in our own mind just to justify like our laziness or something. So yeah. Definitely. Okay, so I think we graduated from the case studies, and they were very, very interesting. And I always like to learn from real practical histories because you can better, yeah, learn the lessons to be learned, I
Yeah,
guess.
and I wanted to use like Theon and Nordrest because I've already, in essence, like pitched them before. So you can see this. Somebody wants to, trace it. They can find a little bit of some past information I've spoken to it. So it's not like I'm just, these are just two companies that done very well, and I'm just making up, like past facts in order to like make myself look good. I mean, we've been invested for a while. There's a public record of us being invested for a while, always saying that we've been invested. So I think that's helpful too.
Yeah, for sure. And I would dare someone doubting you because I feel like you come across as like one of the most honest investors out there. So yeah, but you never know, right? So better be sure. Um, yeah, so maybe I have some questions on your process and how you think about investing in general.
Sure.
I have a big one, but I will make it more concise. Basically, a lot of investors reflect back on their research or names they looked at in the past, and then they see like, oh no, the stock like went up 100%, or "Oh, it's a multi-bagger now and I didn't invest for some reason." um, I want to understand, how do you take lessons from that, and I guess not be biased, because there's also the other side of the coin where you looked at the name and then it drops 90% and you don't pay attention because like you don't track it or something. So how do you learn from past investments with the knowledge that the feedback loop isn't always like 1 + 1 = 2?
I mean, are we talking about like past investments that I've made, or past investments that I should have made, or and I didn't make?
I
Because
guess
because a mature stock picker will always sell a bit too early or a bit late, right? There's are we talking about that kind of like, how do I like a error of omission for selling too early kind of issue, or
Yeah, I'd say both. So basically, how, let's say you looked at 10 names last year or something, you end
okay.
up buying one, the other nine you don't buy. Some will go up, some will go down. Like, how do you learn from your research, or like the research you have done in the past, in such a way that doesn't mix like cause and effect? And yeah, like sometimes it's not really that easy to derive lessons.
Yeah, I
from
mean,
the past?
I think there's the uh, I think there's the old joke in investing about the double bypass, right? Which is uh, the one the stock you sold goes up, and the one you buy goes down, right? So that it's almost like that's like the worst feeling. I mean, I don't know if there's an easy answer to that, David, because you know you always will have in your list of companies certain stocks that I mean, what are the odds if you're buying 1 out of 10 or 3 out of 10, right? That you're buying the ones that go up the most out of that 10. I mean, um, especially in a short period of time, probably not that great. So it always comes back to like the Buffett questions, the Munger questions, right? Can you understand it, right? And then, but even if of these 10, if you understand them, um, always the questions like, well, why did it go up? Right? Did it go up for fundamental reasons? Did it just go up for technical reasons? Is it a hot area? These are all sorts of issues, but I really don't kill myself over like missing certain names that don't go up or things like that. I don't think. I think all you can basically do is like control what you can control, which is like the positions you have in your portfolio. And if you miss a certain stock, you're always going to miss certain stocks. It doesn't really bother me. I'm sorry, I don't have a special answer for that one.
No worries, no worries. I think I can reframe it in a more simple way. Maybe. Do you prefer selling too early or yeah, selling too late?
I prefer to sell too early. My experience is to sell too late. Um, uh, the reason I sell too late is that I, 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 I technically usually give a lot of leeway to my core positions or even positions I've held in a long time. I'm not really uh, watching them. I don't really emphasize too much the latest information. So I'm not going to, just because they missed a quarter, I'm not necessarily going to dump it. So I tend to give like at least if it's a long term position, a quarter, like this doesn't 1 quarter, but 2 quarters or 3 quarters, and sometimes that's an error. I will say this though, I think a lot of investors are sort of disappointed if something they sell goes up or continues to go up or goes up at a good clip. And that really doesn't bother me too much because that means that I made a very good decision to put in the portfolio the first time. Okay, maybe I made the wrong decision to sell it or to trim it, but my basic stock analysis was correct the first time around. And in fact, I would be very distressed if large positions I own sink after I sell them because I'm buying into what I hope develop into really good businesses fairly early in their life cycle. Right now, of course, you got to take into account valuation because even a great business could be a poor investment at some price. But the error of omission that bothers me the most is misvaluation and misunderstanding of the business and industry. Not what happens after if I sell it or what happens if I didn't buy it.
Yeah, yeah. I recently reflected on that because I guess the more conservative way is to sell too early on average, because at least that's my thought process. Because like you can always find another one, hopefully, in most markets if you do enough work. And yeah, you can't go back and into the past and sell earlier. So I guess, yeah, sometimes it's more of picking your poison and sticking to it rather than, I don't know,
Yeah, I do
having
also
the perfect.
I have a rule is that if I sell a stock, I continue following it for 2 quarters minimum,
Hmm,
because it's always possible that the sell decision was a mistake. And particularly if you put in months or years into learning about that company, learning about that industry, it seems a waste just to toss all that knowledge just because you've sold out of position.
right.
Uh, so So yeah, I mean, I think there are times, and it's so hard, right? Once you sell something completely to go back into it. But if you just have some kind of rule, and some people I know just don't sell out everything, like they leave a little bit left in their portfolio just so they can always be adding or subtracting rather than just completely in or completely out. But I think having a rule by which you're like, okay, even if we're sold, we're not going to stop following it, is the better way to go.
Hmm. Nice. Yeah, that's definitely an interesting one. I will see and test it for myself. Because yeah, it makes sense. You already made the investment. I guess you can always use it in other investment cases, but yeah, it's also a way of humbling yourself and really uh, closing the feedback loop, right? So understanding whether that sell decision was the correct one or not,
And
at
usually
least in
doesn't
the
take
short
too
term.
much. If you know a company very well, if you know an industry very well, it usually doesn't take too much energy to follow a specific stock, right? It takes
Hmm.
much less time and energy than to pick up a whole new company in a whole new industry. So
True.
I don't view it as a big time suck.
Nice. Yeah, definitely. My next question is actually, how was it being around the big market crashes of this century, and
Mhm.
what kind of lessons do you learn from that? Because I've never experienced a big crash in my life. So yeah, what can you teach me? I guess.
Well, I mean, I presume of this century, we're talking about the 21st century, right? Not
Yeah.
because yeah, because I don't remember the 1973 bear market very well because I was less than years old. So I can tell
Yeah.
you that I was crying a lot during the 73 bear market, but that probably wasn't because it was a bear market. So for me, like the 2000 crash and subsequent bear market was actually it was actually quite an enjoyable experience because I started investing in the mid 1990s. By 1997, I was participating on the Motley Fool stock boards. There was a prominent Berkshire Hathaway board where defenders of the value faith congregated as the market ripped higher. And I was still a young investor, let me see, going through my investing 101 reading list. So, Buffett and Graham and Lynch and John Neff. It made me skeptical about that whole dot-com phase. And we forget, but the former Fed chairman Alan Greenspan made his famous, like, irrational exuberance speech. It was late 1996. So it took 3 years for the market really to reach its dot-com zenith. Having bought a little Berkshire Hathaway Class B in early 1998, it was a straightforward decision for me to pile in heavy as the stock fell in 1999. For young investors, adding to something you own, which declined, is often easier than adding to a rising stock, right? Berkshire Hathaway at the time could be roughly valued on a price to book basis, and I idolized Buffett. So I was fortunate I had the right investing skills to make a good portfolio decision at the time. As you're building skills, you want to stretch your abilities, but you also have to like recognize your limits too. So like along with my like fellow value investors in 2000, I felt vindicated and triumphant, right? When the market crashed. It's easy, but it's easy to learn the wrong lessons and position your portfolio for the wrong future. The lesson I learned from 2000 was to favor value over growth. The best, I think, risk-adjusted move for most investors after the dot-com crash bear market, with 2020 hindsight, would have been to favor a diversified basket of assets, including gold and bonds, actually. So when the market drifted lower and lower as the high PE stocks crashed, in 2000, I was making gains thanks to a value tilted portfolio. But what saved me from taking a blood oath to the value mafia was once again my family business experience, right? It was so hard to get top line growth in my own business, my own industry. But I could see that like slow top line growth or like stagnation really compromises you. It makes it more difficult to recruit ambitious people because you're like in an efficiency like cutting mode, not expansion growth mode. It makes it more difficult to achieve operating leverage. Yeah, true. Peter Lynch, he says, growing industries attract more competition, more players, but tough industries can encourage some companies to try desperate moves, desperate pricing. Plus, like running a business means that I don't have time to like dart in and out of positions. Part of growing up as an investor is merging like classic examples with your own skill set, like interests and talent. So like my solution was to combine Lynch's fast grower approach, with Buffett's slower turnover rate, and add Phil Fisher's scuttlebutt and research to my own personal experience, and there you go. So remember, like the David, the stock market, the S&P 500 peaked in like March 2000. I think it was around 1550, and did not reach a new high to like mid-July 2007, actually. So then it drifted higher until October, and reached a new record. And then along comes the Great Recession, and the S&P 500 falls again. It doesn't surpass that October 2007 high until, what was it? Spring of 2013. Spring of 2013. So basically, for like 13 years, the S&P 500 experienced like a volatile and sometimes violent, but nonetheless sideways move. So for nearly half my investing career, the S&P 500 was in a funk. Now, the 2008 crash was a different story. Like the 2000 crash, that was great for me. 2008 crash, different story, right? I don't care if your equity portfolio was tilted towards value or growth, large or small. I mean, you just got smashed. Correlations went to like 1, unless you were like brilliant enough to position yourself like in defensive names like a Dollar Tree and McDonald's and Walmart right before the crash. And then as the economy crashed, you were pressing enough to switch to aggression in 2009. I mean, you just got hit. Now, there are probably some illiquid microcap names that did well, in part because they avoided margin calls. They were just too illiquid to sell, just some oddball names. But of course, Mr. Market, he has like a wonderful sense of humor, right? What worked best coming out of the Great Recession in 2008, like aggression, growth, America, tech, not classic value, not asset diversification. So, I think good investors are superb pattern recognition machines, but often their recognition is like tied to a specific market environment. Like the great investors, they can reprogram that pattern recognition code to like changing market conditions. But it sounds easier than it is. Like here in 2025, what happens if multiples contract rather than expand? And not for days or for months, but for years, right? What happens if the market rewards like income investing rather than growth compounders? What happens when like outperformance means like losing less money rather than making more? What happens if change means recognizing that some, maybe a lot of your past success was down to luck rather than smarts? How many people can adapt? Because it's not easy to move away from your tribe or your approach, right? Look at the suffering the small cap value guys have experienced for like quite a long time, right? Yeah, and a compounder bro, right? Those wonderful compounder bros, they may declare like, "Hey, man, that won't happen to me." But let's be brutally honest, like that's exactly what you would expect a compounder bro to say, right? Like it won't happen to me. So let me just have one old man yelling at clouds statement here. You really have to reserve final judgment for an investment record, including your own. You have to reserve final judgment for investment record. That you have to reserve it if it does not cover more than like two very different market environments. It's that ability to adapt to a totally different market environment, which really makes or breaks your long career.
All right. Yeah, makes sense. And I don't know who said this, but yeah, someone made a similar statement saying you should only judge whether your life was successful or not, like at the end, not in the middle, because yeah, everything can happen. So
The problem is
that
though,
goes in line with
we do
that.
have to we live now though, right? We live in the
Hmm.
present.
Yeah,
So, and we do have to sort of judge, if somebody has a 3-year career, 5-year career, 7-year career. I mean, you have to make some judgments, or you have to make some adaptations. You have to decide whether to put money with that individual or not, right? I mean, are we only going to look at people who were invested in the market before 2008?
yeah,
That's a long time ago. So
true.
these are not easy calls.
Yeah, for sure. Do you have time for three extra questions
I
or
have all the time in the world for you. Well,
nice?
not all the time in the world, but I have more
Yeah,
time.
yeah.
I have more time.
Okay. So I'm really curious to know if you finish university and you have to find a job or do something, right? You can't just stay at home and play PlayStation, uh, and you can't go to your family business because
Yeah.
yeah, that's not an option in this universe. So what would you do, or what business would you start, or would you go work for, I guess?
I mean, it's a difficult question, David, because I'm influenced by like 25 plus years of like work experience,
True.
right? So what I can tell you is what a younger Jason Hirschman would probably have done,
Mhm.
right? So back in 1994, um, I was sitting in a computer lab, let's say, in the bio building at the University of Chicago with my future wife, looking at a stupid word glowing on a computer monitor. And I told my future wife, what kind of company names itself this? Like Yahoo? Like real computer companies, call themselves Hewlett Packard or Texas Instruments or Microsoft. Yahoo with an exclamation point? It's like so dumb. So, I would love to like sit here and tell you that if not for being an investor, I would have founded Instagram. Uh, but no, that would not have happened. Which actually amusing, funnily enough, is that a student from my high school who graduated 11 years after me actually did start Instagram. Um, what's also
cool,
amusing, I'm sorry?
cool.
Cool. And also, what's also amusing is that the original founder of AOL, a guy, wonderful name, William von Meister, also attended the same high school as me. So we got the AOL founder and we got Instagram founder, and I am the underachieving schmuck in the middle. But 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 back to your question, I think before I loved investing, I loved writing. In high school, I founded a alternative opinion magazine along with five other friends. Um, One of them later worked for William F. Buckley at National Review and then became an editorial page editor at the Los Angeles Daily News. One of them co-founded a early digital image company, and one of them earned a Pulitzer Prize and is also a New York Times opinion columnist. So my best guess is that I would have tried to become an opinion writer myself.
Hmm. Nice. Yeah, and actually, there's a big correlation between liking writing and being, I guess, um, I would say, a member of these communities where you have to write a thesis and so on. Uh, and actually, I guess you found the middle ground where you can still write. I don't know how much writing you do as of
It's
now,
it's
but
it's tougher. It's tougher to do writing now because when I write, I have a bit of a like a somewhat sarcastic writing persona, and I don't like to come down harshly on particularly younger investors, and
Mhm.
it can come down. So I got to be very careful what I write these days. But I do like to joke with my wife that I am the one of the most highest paid writers in the world
Yeah,
because it was my writing, particularly on the Motley Fool boards, that introduced me to some other investors who made a big difference in my life. Who one of them, which introduced me to Microcap Club, which introduced me to the person I really worked closely with on Expel, there's a lot of great things that happened to my life because of writing, but it was a backdoor way, right? It wasn't the just okay. I got a job that gave me a paycheck for writing opinion articles,
true.
which is good
Yeah.
because the even when I was graduating college, the newspaper industry was really starting to decline. So it all
Mm.
works out in the end. And
Yeah,
fortunately, I used my skills and my passion to good outcomes. I think.
nice. I have kind of a different question now.
Mhm.
I regard you as a very good uh, investor when it comes to judging management and assessing management. So I'm really curious to know if you had to give say two or three tips to a CEO that has never managed a public company on how they should communicate with the market and investors, and other than having a fundamentally good business, which I guess is the base of everything. But yeah, what would you tell them, and how do you think about shareholder communication in general?
Yeah, that's a it's a tough question because the let me ask you this hypothetical company,
Yeah,
are they making money or are they losing money? Do they need to do a secondary, or are they in good financial shape?
let's say it's like a, a small business, like a 100 million market cap company, earning 10 million in EBITDA, and yeah, facing no problems as of now, like just standard company that is profitable and is in a decent industry, I'd say, growing, um, growing decently, like 10% or something.
Yeah, I mean, I think it's it's tough because I think there's the answer. There's a presumption out there that microcap companies need to do a better job communicating,
Hmm.
and I'm not 100% sure that's true.
Hmm.
In fact, in fact, my opinion, uh, and I think most microcap investors will disagree with me. I think most microcaps do an excellent job when it comes to reporting shareholder communications, particularly the ones that hire expensive professional investor relation services. And I'm not joking. I'm like completely serious because I think the job of an IR firm for microcap is similar to like a role like an attorney in a civil or criminal case basis, right? It is to offer a compelling vision of the situation to best help their client achieve their objective, like raise the share price, consummate a share secondary, or for an attorney, win their client like a verdict in their favor. Right? As an officer of the court, like an attorney should not lie, but they can interpret. Right? The same rule applies to like an IR firm or many microcaps. And considering how many microcaps successfully raise round after round of secondaries, considering how many microcaps um, balance sheets I've examined, which show like tens of $1 million of losses, and with the same management team plugging away, the system works pretty well. I mean, the market exists to raise capital for businesses, and it just needs to generate sufficient returns, including a handful of amazing returns, to keep investors zooming and funding. Right? The system does not exist to make you rich. It exists to keep microcaps solvent. Positive returns, positive wealth for investors is a side effect. Right? What the microcap market does not do, in my opinion, and it doesn't make it a no-brainer to determine what to invest in, what to avoid. That difficult but worthwhile task is our job as an investor, right? Which is to treat every comment by microcap IR firm or CEO with a healthy degree of skepticism until that trust is earned. So let me just give you, for example, like for my personal amusement, mostly for my personal amusement, I've experimented with some like ABC testing with Swedish microcaps, and this gets like directly to you, like what would you tell the CEO? So I've helped Hype Group get the story out, and management is like eager to get their story out, and the stock is like responded amazingly. Like it's much closer to fair value now than a couple of years ago. Like for Nordrest, I've done a single pitch until today, and only a couple of like lesser known Substack FinTwit posters have like even mentioned the stock, right? And management doesn't even like to really talk to small investors or many prospective investors. Yet, it is up a lot too, like on its way to fair value. Finally, there's a third Swedish microcap with absolutely no FinTwit posts or Substack write-ups, and little to no like Swedish analyst support. I don't think there's any Swedish analyst report. I think it has a lot of potential. We've bought over 3% of the firm, and it's heading up too, strangely enough. So, look, what would I say to that microcap investor that 10 times EBITDA, just keep chugging along, right? I mean, I don't think you have to really worry about it. Um, there's honestly, it's like, look, yeah, a group of well-known investors and a few good pitches can accelerate the process. So my if I had to give advice, if you put a gun to my head, I would say, like, look, always find a few good, well-known microcap investors out there, get them to understand your story, okay? And they will be the ones that will carry the water for the stock, right? That is the best way. Like, it's one thing for the management team to pitch it, but when you hear a pitch from like a respected investor, that is a much better situation for, I think there's a lot of investors like that prefer that approach. So my advice, if I had to give it, is connect with another prominent investor. But look, if a stock price shoots up, if it gets divorced from its underlying intrinsic value, I don't know if that's actually better than like a stock that rises in proportion or like moderately lags intrinsic value. I'm not sure that's better long term for like the investors or management. Look, and people get annoyed at microcaps that like exaggerate. But come on, the average microcap investor in the United States, at least in the United States, is like a young man. He spends his free time looking for new microcaps. He spends his free time looking for a new job. He spends his free time with his girlfriend, or dare I say, like, looking for a girlfriend or looking for a new girlfriend, right? Given the amount of exaggeration on LinkedIn about job profiles or on dating sites, just to get a first round interview or get a first date, I mean, there's so much exaggeration that people do in their own lives. So I don't think any microcap investor should complain if a microcap spins itself a little too positively. Like, look at your own LinkedIn profile, look at your dating profile. Come on. Like, honestly, look, we're in the golden era of microcaps. I mean, it's not perfect. We need a lighter regulatory touch in the US. We need cheaper methods of replacing inadequate boards, but nothing's perfect. We can, as investors, we have affordable access now to an entire world of like tiny public companies. Like Ian Castle's like Microcap Club is not only a hub for like members, but a valuable resource for like paid subscribers. There's a growing community of Substack writers who are churning out article after article, right, on microcaps. I'm like, it's raining ideas these days, right? And you can't go 5 minutes on Twitter or like without being like hit with a new idea. So, and some of these guys are making a living or a good side income from their Substacks. I mean, to me, it's just like a pretty amazing microcap time.
Yeah, definitely very, very interesting. And I like your answer, because I feel like that's the truth. And it's also hard to answer these very general questions, I'd say. Just to, as you like to do, to dig deeper,
Yes.
I'll ask the reverse question. So if you're a company and you want to attract short-term investors with a short time frame that are probably not going to be the right stakeholders to partner with for the long term, if you have a long-term plan to execute, say Expel in the early days when you found it, how would you not communicate with the markets, so to speak? Like, what rules would you or what things would you avoid doing in order to keep these people out?
I mean, if I've wanted to make my stock, if I understand your question correctly, if I want to make myself and my stock unattractive to long-term investors,
Yeah,
or attractive to,
yeah,
okay.
exactly.
Well, I think the thing, I mean, there's a certain list of behaviors which I think every microcap investor dislikes, right? The first thing you can always do, you can hit them with a share secondary much below the current share price, right? There's nothing that turns off microcap investors like a poorly timed share secondary that basically turns whatever price you paid into a loss. So I think that's the first thing you do. The second thing you do is to always make sure that you file a NT10Q. You're never on time when you have to turn in your quarterly report. The third thing you can do is um, is is be belligerent with investors who are asking very basic questions. And I'm going to be a little cheeky here, and I'm going to say, like, look, uh, we don't have to talk hypothetically. You could actually look at the track record of Innovative Foods before they changed their CEO, right? And see the kind of reaction that he had from the marketplace, right? When he also made some acquisitions that were just burning money, and see how a company with fundamentally decent business can become so unattractive to a large number of microcap investors, most of which may have like researched the stock or at least entered the stock with high aspirations and a decent amount of patience in the beginning. So we do have track records, and I hate to. I actually don't hate it, but I just mentioned a certain name because you can see what happens, right? But the advantage is, you could flip it, right? You can go from a CEO who's disliked, and then he can leave, and then a new CEO can come in here, reset the business, make progress, and the stock can react wonderfully as Innovative Food did under the new CEO. So. And it doesn't really have to be. It's not a question of being a good person or bad person. Sometimes certain people just don't have the right personality to be a public CEO.
Hmm. Yeah, yeah, for sure. I think it's a very complex kind of because it's very specific, and there's a point to be made where like it's actually interesting to pay attention to these companies that are doing a very poor job at communicating with the market or taking care of minority shareholders, because then a new guy can come in and easily turn things. I'm not saying easily because nothing is easy in this world, but yeah, with the modest skill and luck, turn things around. So yeah,
And it's also it's interesting because there's been a number of particularly in the food microcaps. I think Mama Mancini, Mama's Creations also had a change of CEO. There was also um, I forget this. Armamino's like food of like Armamino's, I think like something food of distinction. I forgot what it is. I can't believe you would name a company something of distinction, but there you go. That also had a CEO change and remarkable turnaround. So there's something to be said for a change in CEOs as if you're like looking for a strategy. That being said, it's again, it goes back to pattern recognition, right? Once you see two or three, four CEO changes in a microcap, setups that work in the microcap community, guess what everyone's focused on, right? Everyone's looking for CEO changes, and therefore the stock price can react very quickly or too much simply because of a CEO change. So it's always a dynamic situation in the marketplace, right? Any strategy that's like somewhat obvious, like okay, a CEO change, if it works, people will pile in. So you always have to try and look for a new kind of strategy or new kind of advantage.
mhm. Yeah, for sure. If it was easy, everyone would be, yeah, an outstanding investor. So yeah, I guess that's also part of the fun we get. So finding these new strategies that work, or realizing that our strategy doesn't work anymore, or yeah, just adapting all the time. Yeah. So I think that's a wrap. I had some more questions in here, but maybe we can do a follow up at some point
No, I'm happy if
and
you
talk.
want to do one more question, we could do one more question, but it's up to you.
Yeah, yeah. Maybe you could just this very personal question that I've been kind of thinking for myself for a long time. I'm
Okay.
not sure I have an answer, but how do you manage your ego and overconfidence, and how do you stay both intellectually humble and socially humble? as you have been very successful in what you do?
David, that's is a. I'm going to give you an answer, and it may not be the answer that you or your listeners are expecting. There's a certain answer. There's a certain correct answer to give to this kind of question,
Mhm.
and I want you to, the intellectually humble contrarian. Let's say, does this person actually exist? And I'll
Mhm.
let you in on a little. You and your listeners in for a little secret, but don't tell anyone else. Uh, I've met a lot of really great investors, and all of them, all of them had very healthy egos, were very confident, and they were not intellectually, they're not intellectually humble. I mean, they think highly of their own investing abilities, and that's fine because they're like accurate in their assessment. They're really good in investing, but I think they're also smart enough to like present themselves as humble because they use modesty as a tool for connecting with others. Like in the United States,
Right.
and I would suspect even more in Europe, no one likes a braggart or egotist, even if he's extremely competent, right? So it's better to stay well on the side of humility than to risk looking like a jerk. But the truth is, I think if we're honest, like it takes an unusual degree of like self-confidence and self-regard uh, to believe that when Warren Buffett says, be greedy when others are fearful, that I can be the one to avoid fear at the wrong time, and I can identify when to be greedy, and I know what to grab. I don't think anybody who studies Charlie Munger thinks like, boy, that's one humble human being. Now, I'm using the former definition of humble, which refers to like a modest or low view of oneself or like low in rank. Avoiding arrogance does not automatically make one humble.
Yeah.
I think, and again, I'm trying to be honest here. What's crucial is to stay intellectually honest with
Mhm.
oneself. Like avoid delusion. Actually, if you rank high on honesty and rank high on delusion avoidance, I think actually a big ego can be useful
Right.
because it serves as motivation to fix any flaw, to like solve any problem, to work any length of time. Because like falling short of your own super high regard for yourself is just simply intolerable for the person with a big ego. So again, I'm not sure that's the answer you were expecting, but that's the answer you're going to get.
I've asked this to so many people, and this is the first time someone gives me like this answer. So yeah, I really appreciate your honesty. I can tell you maybe just to for the knowledge of the audience and your knowledge what other people have told me. So
Okay.
I have a couple of funny ones. One is get a wife. That's one of the answers I get often. The second one is you just need to fail a couple of times to be humble. Because I guess when ego drifts too high, and you do mistakes because you're overconfident, then life kind of has a way to show you that maybe you were yeah, being a bit too overconfident. But and then like there's the more religious kind of answer, which is like forget about yourself and yeah, just think more about others and so on. But yeah, I really appreciate your answer, and I think it rings very true. So yeah, thank you for your honesty and your time. And I don't know if you want to say some words before we wrap this up, but I'm very grateful for this 1 hour and 20 minutes conversation
No, I
we
and
just had.
just I appreciate the conversation, and I always enjoy talking about stocks. And people, if they're interested in reaching out to me, they could find me on Twitter, Jason Hirschman at ATRAC 180, or on Microcap Club. Always happy to be reached out on via Microcap Club too. And so again, David, thank you very much, and we should have another conversation down the line.